And before I get directly into CPI of Consumer Electronics and some of the other pieces of the Fed, I just want to give a quick story about when I was at Morgan Stanley. So my old boss, and this was during 2008, I was asking, and I was fairly new and wanted to get the managing director's input on this. And I asked him, I said, how does this end? Like, how does QE end at this point? Because we saw what Bernanke was doing. We saw what other nations were doing. And he described it as central banks, once they start. And again, Alan Greenspan paved the way of low rates, no need for these elevated rates. So he's like, this is the culmination of that. So now his view was that central banks weren't going to even break. They were going to just speed to the end of their balance sheets and then have this beautiful dive off, and he, as he described, screaming like a pig, going wee all the way down. And he was right. But when I said to him, how long is that going to take? And he said, it could be 20 years, it could be 30 years. It's whatever the length of the balance sheet is there. And when people lose confidence, and he likened it back to Japan, saying, look, they've been doing it since 1998. It's now 2008, and they've been doing it for 10 years, and they show no sign of stopping. He's like, so could the U.S. do it for 20, 30 years? He's like, there is an end, and it's going to be ugly, but they're going to ride their balance sheet to the end of time, and then that's when the unwind happens. And he was right. And when you look at what happened, every central bank was scared to raise rates, was scared to do QE. You had pauses, but anytime you talked about shrinking the balance sheet, you had a taper tantrum. Now there's no choice. And his whole thing is they can't let themselves get to a point where they have no choice. Like in 2020, when you had multiple entities becoming insolvent, the Fed could step in and they could stay there. And as we said, the biggest policy error they made was they stayed too long. There was nothing, and I mean nothing in the world that showed 2021 needed support on home prices. But yet they were buying mortgage-backed securities. Why? What were you trying to protect? What were you trying to create? Now you have these massively elevated prices that are crashing down. We're going to talk about that in the next segment. But these are the issues now because every central bank is now in the same position and there is no buyer of last resort, which is why we have inflation going up. We have bond volatility come up. And typically when there's bond volatility, the central bank steps in, issues QE, and brings it down. There's no choice. The UK, the Bank of England just did that. They stepped in, but as they said, we can step in, but we have to step back out because they have no choice. Now, the BOE is an interesting, the Bank of England, because you have the government issuing tax cuts, the biggest since 1972, in front of inflation, in front of other types of issues. So now you're increasing money to people, which is going to help increase their demand, where you really want their demand to shrink. And the BOE is trying to correct that by, again, absorbing the excess by raising rates. So this is where you see some of these different problems. And again, they've run themselves off a cliff. Now, when you look at CPI, there is some deflation, as we talked about earlier, and this is just looking at what's happening in the U.S. in general. So computers, telecoms, visual, audio, consumer electronic prices within CPI have come down recently, with some TVs seeing double-digit declines, which again is a positive, but everybody used government money to buy them in 2020 and 2021. So even though prices have come down, there's still no buyer, and there's such a backlog in chips and now glass and other pieces that you still have that, again, those issues that continue to reverberate through the system. Now, when you look at just looking at the housing side, so the real 30-year fixed rate mortgage rate has now risen 4 percentage points this year, which is far above the 1% point rise in the 2013 taper tantrum. The U.S. housing sector is already moving into a deep recession. And again, when you look at the sell-offs between the two, That's why we talk about that taper tantrum. And now, because they stepped in so aggressively in 2020 and 2021, they have no choice but to let this play out. And it won't be as bad this time around. And we'll talk about that in a minute, only because you do have people that are sitting on homes that are grossly overvalued, but at 2.3%, 2.5%. So you can, as a homeowner, can sit there, pay this crazy low rate, earn back some of that equity, but it just means you're not moving. You're stuck in that house. Because if you try to liquidate, you're going to have to take a bath, and until you can recoup some of that equity, it's unlikely you're going to make that move, which is going to create other stagnation in that entity. But we'll talk more about that in the next segment. Now, when you look at the U.S. deficit as a percentage of GDP, it's back to negative 3.2%, and it's because you've had subsidies coming down. You've seen some of those slowdowns, but we have a spending problem. And as you can see, we've had a spending problem going back to 2001. So at what point do we see some austerity? Do we see some of those issues adjusting to try to cover for some of these underlying shortfalls? Because the market is getting more and more expensive. So as we try to issue more debt, as we try, our interest expense is going to go up, and to close this shortfall and to run this deficit is going to become more and more and more expensive, creating other issues. So now when you look at the federal funds rate across the different tightening cycles, you can see where we sit right now. And again, as we've said, we're going higher. We're going over 4%. And the reason why is they want to avoid the wage spiral. And we have the chart later in segment in segment 3. Wages have not come up to meet. They've risen, but when you look at housing, you look at wages, you want to avoid a wage spiral. And when you look at the jobs data, the unemployment number was very good. When you look at the new jobless claims, below estimates. There's still space in this market to see rates go up because inflation is still going up. It's still trending higher. We'll talk about that in a minute. So again, the Fed put that everyone loves to talk about, you're just not seeing that. And again, that Fed put is much lower than what people expect, creating additional shortfalls. The slight easing in Fed fund rate expectations still at 4.65%. And again, we don't see that adjusting as the trajectory remains higher. Liquidity conditions in the U.S. Treasury market improved a bit yesterday, but again, you can see the recent spike is close to the March 2020 crisis levels, and that's because when you look at volume, the Fed is no longer a buyer but a seller. So they're pushing more stuff into the market. You're seeing, again, this avoidance. And one of the things that we also talked about, and my boss had highlighted, was that you were going to see bonds trading through the tail, because typically there's a when issued of what is the expected rate, and we continue to see that slippage as rates drift higher because people are demanding a higher price because they are either taking less bonds or they see inflation and they want protection against it because we continue to see that inflationary pressure driving higher. Now, the liquidity tide so we still have growth. The M2 growth is up 4.1% year on year, but you can see it's the slowest since April 2019, and we expect it to continue to come down. And as that liquidity tightens, again, that's going to drive up emerging market debt. That's going to increase pressure on emerging market currencies, and again, also put more pressure on the U.S. rate side. Now, when you look at the MOVE index, which is the top left, that black and white one, you can see that we have now hit the new high for bond volatility in 2022 and are now back at the highs we saw in March of 2020. The problem is, as we know, in March of 2020, when we got to this level, we had a massive issuance of liquidity coming from the Fed. We do not have that ability this time, which is what we continue to talk about as the big driving force in terms of inflation, in terms of issues, which is why we're going to continue to be under this level. And then when you look at retail sales and policy tightening cycles, you can see just how far we are from these adjustments, which is why we expect to see more pressure. And the consumer is just only now starting to see these cracks, which is why the pressure is going to continue through this year and again reverberate into next year. The 10-year government bond yield, I've officially won additional bets. I had said that the 10-year was going over 4%. I don't know if I should be happy about winning that or just sad for just the pain that we're going to see. But again, we believe that the 10-year is going to continue to move over 4%. And there will be more pressure, and the likely next stop is going to be 4.5%, with the 30-year fixed mortgage rates, as of the most recent readings, according to Mortgage News Daily, is now at over 7%, which again, just increasing the pain for the consumer who's looking to buy a new home. All in all, that's resulting in more panic creeping back into the market. The panic euphoria model has fallen slightly below June's fear levels, but not yet consistent with prior bear market lows, which again, as you see the Goldman Sachs Financial Conditions Index getting worse, now it's worse than where it was in 2020. In 2020, it's now approaching where we were in 2008, and there's still some of that slight dip buying, and we still haven't seen real panic on the retail side, which we're seeing here. So retail purchases of single stocks versus ETFs have slowed, but when you look at retail capitulation, we are not seeing it. We are still not seeing panic. You still have people holding in, some buying the dip. It's slowed, but there's still not this underlying fear in the market. And everyone, and especially people that I talk to on the retail level, still expect that Powell put. They still expect Powell to bail people out, central banks to bail people out, because you've been trained to. I mean, going back to Greenspan, continuing with Bernanke, then again with Yellen, and then obviously Powell in 2020, you've been taught to expect that. My point is that is now gone, and people are still trying to fight the Fed. And the CEOs are saying it. So CEO confidence is near its 40-year low, obviously deeply in recessionary territories, and that doesn't speak well for U.S. profits, corporate profits, because they're seeing what's on their balance sheet, they're seeing the margin, they're seeing the problems. So again, you still have way more downside when you look at earnings expansion, earnings problems, and what those write-downs are going to look like. Now, when you start looking at some of the leading indicators, input prices have come down a bit, but as we've said, they're still high and they're still rising. So they will normalize a bit. They have gotten a bit slower, but again, you're still seeing some of those pressure points. The prices charged, again, coming down a bit, but as input prices remain elevated, prices charged come down, margin compression. That is, there's more margin, but you're starting to see it level off, and we think prices charged, again, flatline at this elevated level, keeping some of that pressure in the backdrop. And again, following on those CEO comments, CapEx outlook. If you look at the leading indicators for CapEx, you're coming down, but we haven't started to see that rollover. You've seen it with announced reductions. You've seen hiring freezes. All of these things again are leading to some of these different pressure points. And again, looking at those leading indicators, we're going to see that shrinking, which is going to put more pressure on the local economy, which, if you think about the U.S. and the sheer size, a much bigger problem on the global economy. The Richmond Fed, so the rebound manufacturing index in September bounced to 0 from -10. New orders and business conditions ticked higher, but are still contracting. Shipments moved into expansion. Employment fell to 0, lowest since July 2020. So very mixed. Again, you're still in this kind of bouncing sideways, but when you look at CapEx, when you look at those leading indicators, export orders, new orders, that's where, again, we're still on the downward trend, But as we said, nothing dies in a straight line. And we've been talking about kind of bouncing along here negative. It's in contraction, but again, sideways. It's that Q4 into 2023 that we see that bigger kind of commitment to the downside and those bigger pressure points. The Richmond Fed new orders, you can see that bounce, but the backlog of orders is down substantially. So again, new orders slightly better, but the backlog was so far down that even the new expected new orders isn't going to offset. So still moving in that negative direction, in the contraction, which we've been highlighting. Now, prices paid coming down a bit, but as you can see where they are, prices received, again, still elevated, but you had that downward move. But again, we expect that Chevron pattern, some of that cooling off, but more of that remains, especially when you look at wages and some of the other embedded costs, because inventory was bought at higher levels. So if you want to try to pass some of that through, continue some of that through, it's going to result in higher prices. Dallas Fed, so manufacturing came in at negative 17.2 versus the estimate of negative 10. New orders dipped to negative 6.4. Production picked up, shipments rose, and delivery times popped back into expansionary territory. Hours worked rolled over to the lowest since May. Employment still expanding, but again, that movement down. You can see it's still negative, it's still contracting, and all of the other important pieces are rolling negative, showing some of that trajectory. So then when you look at the volume of new orders, so companies see slower growth in new orders now, but their outlook improved significantly in September. So this is good. So you see some new orders coming in, but the outlook still remains up weak. But again, new orders forecast. So there's that mixture of, depending on how much comes through and we'll talk about this in the next segment on new home sales, some of this is going to come from canceled orders. So the volume of new orders is there, but new orders forecast has gotten better based on what's indicated, but we're starting to see cancellations roll through, which is why we think the blue number, that negative 6.4, is truer to where it is in terms of things that are not going to actually come to full fruition. Then when you look at the Dallas Fed, staying employed but working less. So here you can see that employment component within the Dallas Fed manufacturing index held up in September, but the average work week rolled over. So again, it's kind of that mix of, well, you still have expanding a number of employees, but they're working less. So again, you're seeing that slash to, well, instead of working 40 hours, you're going to work 34 hours, and you're slashing some of their hourly jobs and hourly work to keep some of that cost savings. Then when you look at Chicago Fed, National Activity Index came in flat in August after a 0.29 increase in July. Production income component turned negative, while personal consumption and housing, sales, orders, and employment were positive. So some of the leading indicators going down, some of the kind of current ones flat, but again, the movement is to the downside, and this is where we see that accelerating in Q4. Consistent with the broader measures of hours worked, the work week component within the Richmond Fed manufacturing index has fallen swiftly. So again, you're seeing something similar to what happened in Dallas, where the work week is coming down, and it's coming down hard, which is, I think, a bigger leading indicator for how much money people are taking home, where the number of employees are the same. So instead of trying to cut a shift or let people go, you're cutting their hours, trying to preserve their jobs. So that's what we have for you on that side. On the next segment, we're going to go deeper into the consumer and, more importantly, housing, and how some of that new data has been developing.